Americans love mutual funds. According to ICI, approximately 100 million Americans own a mutual fund, which is about 1 in every 3 Americans. That's as popular as Amazon Prime. In this video, I will break down exactly what an index fund is, the history of how they were created, and the pros and cons of owning them. As a background, there is over $22 trillion invested in mutual funds. $7 trillion of that amount are in index mutual funds. That means that roughly 1/3 of the mutual fund market is in index funds. So what exactly is a mutual fund, and how are index mutual funds different? As an investor, you want to ask yourself 2 simple questions. Do you want to be a portfolio manager, or do you want to hire a portfolio manager? And number 2, do you want to trade, or do you want to invest? Your answers to these 2 questions will set the course for your Wall Street experience. So what is a mutual fund? Instead of buying individual stocks one at a time, mutual funds enable you to buy hundreds of stocks in one single transaction. And instead of trading your own portfolio, mutual funds enable you to delegate this function to a professional portfolio manager. Think of a mutual fund as hiring a chef for the week and not knowing exactly what ingredients will go into your meals. And think of an index fund as a ready-made meal plan where all the ingredients are specified. There are 10 key benefits for investors to own a mutual fund. Number 1, you get immediate diversification. This lowers your risk. Number 2, it's easy to track your performance. This gives you the ability to make smart decisions quickly. Number 3, you gain access to the top managers, and you don't need millions of dollars to access them. Number 4, mutual funds also give you access to the top indexes. Number 5, mutual funds are simple to buy and sell. This gives you excellent liquidity. Number 6, mutual funds give you the ability to reinvest your dividends automatically. Number 7, mutual funds are regulated by the SEC and FINRA. This protects shareholders. Number 8, you can make automatic monthly deposits. This is a huge advantage to dollar cost averaging. Number 9, every fund comes with a simple manual. It's called a prospectus. And finally, number 10, all shareholders are treated equal. 40 years ago, the founder of Vanguard, Jack Bogle, did a pretty crazy thing. He proposed that owning the entire market was smarter than actually paying portfolio managers to pick and choose which stocks should go into your portfolio. Initially, the industry laughed at him, calling it Bogle's folly. And now, 40 years later, and $7 trillion now invested in index funds, I think Jack's having the last laugh. Mutual funds have been around for 100 years. Let's take a quick look at the history. In 1924, the first mutual fund was launched by MFS. 50 years later, in 1971, the first index fund was launched by Wells Fargo, though it was for institutional investors only. Then, 5 years later, in 1975, the first S&P 500 index fund was available to retail investors. That was introduced by Jack Bogle, eventually becoming Vanguard Funds. In 1993, the first ETF was IPO'd by State Street under ticker symbol SPY. ETFs now have $4 trillion of the index fund market. More on those later. So in a relatively short amount of time, about 1/3 of the mutual fund market is now comprised of index funds. And that growth accelerated even more during the past decade as index funds grew by over 6 times. And we now project them to eclipse 50% of the market in just a couple of years. So why are index funds so popular, and what exactly is an index fund? An index fund is a mutual fund or ETF that is designed to mirror a certain market index that uses a math-based trading formula to track an index like the S&P 500 or the Dow Jones or the Russell, And there's no stock picking or market timing based on human intuition. You're always 100% invested and you always know exactly what you own. Now that doesn't mean you always own the same stocks. Index funds evolve to match the markets they measure. For example, I manage an S&P 500 index fund. And over the last 12 months, we've had 17 positions moved out of the S&P 500 and 17 move into the S&P 500. That's about an average of 1 to 2 companies per month. This keeps the portfolio in what I like to call real time. So let's go over the pros and cons of index funds. Number 1, performance. Index funds outperform over 80% of their manager peers. Depending on the study you look at, these numbers go up as high as 98%. And if you listen to Jack Bogle, he maintains the number goes a lot higher. Number 2, low cost. Index funds have always been the low cost leader because they don't have to pay the manager fees. Number 3, index funds give you the ultimate in diversification. You essentially own the market. For example, the S&P 500, you own the top 500 name brands in America. Number 4, index funds are ideal for long-term buy and hold investors. And since most investors have 401k plans and IRAs that are built on 20 to 30-year time horizons, index funds are a perfect match. So what are the cons to owning an index fund? Portfolio managers claim that index funds are vulnerable to stock market crashes. They say they lack flexibility and that there is no human element. These 3 claims are essentially the same claim made 3 different ways. Because index funds are fully invested, if a stock market crashes, an index fund will experience 100% of the crash. Portfolio managers claim that given the same scenario, they're able to go to cash. And so in theory, their portfolios have more protection and are less vulnerable. Let me take a minute to weigh in on this. In my experience, those 3 claims are the reasons I like index funds. Being fully invested, having a portfolio that's fully transparent and math-based, and not having the human element are the key ingredients to why index funds outperform portfolio managers over time. There's a good reason we believe that index funds are replacing Wall Street, not just becoming a popular investment, but actually replacing Wall Street. They're fully automated, they're low cost, they're simple. Any investor can understand them. Investors love their performance. One of our goals on this channel is to help train our subscribers how they can become millionaires. There's no quick path. This is about knowing your investment strategy, having an investment plan, investing for the long term. Let compounding of interest work for you. Index funds are a great engine to drive your nest egg, but this is going to take 10, 15, 20 years. Compounding really gets magical after about year 7. It's boring at first. You're going to want to trade your portfolio, but remember, that's noise. Invest for the long term. Let the math work for you. You may be wondering, what is the right investment strategy for me? What should my investment plan look like? What index fund should I own? These are all issues we will cover in future episodes. So if you haven't already, give us a like and subscribe below and stay tuned. I'm Mike. Thanks for watching.